Our next guest says the risk investors fear most is a full-blown banking crisis. He says European leaders must work up a plan to recapitalize the banking system. In his words, no bank bailout plan. The euro goes bye-bye. Well, let's talk to Paul Donovan. He's Deputy Head of Global Economics and Managing Director at UBS Investment Bank. Did you enjoy hearing me say your words there? Euro goes bye-bye. Now, we know that you're pessimistic on the euro, but I just want to start from the beginning, if we could, because today we have this crucial vote in the German parliament to push through these expanded measures of the temporary rescue fund. How important is this vote?
I think the markets are assuming it goes through. There seems to be very little prospect of a failure with the SPD backing the government on this particular point. I think the question is how much dissent is there from within the government. If Merkel faces 20 rebels or so from within the coalition, then I think that would create very negative headlines in the media. There would be concerns about German commitment to the euro and so on and so forth. I don't think we get that. I think we go through. I think markets can then concentrate on the next stage of the crisis. So, it's, I think, an evolution that will be okay.
Well, interestingly, markets are kind of already focused on the next stage of solutions, because the solutions that they are voting on today we already know are not going to be enough, and therefore there are other solutions, other options already being bandied about, one of which is to require the banks to take bigger write-downs or private investors on the Greek bonds that they hold. So in other words, renegotiating that second rescue fund. Is that going to have to happen?
We're already there. I mean, the market's assuming a default, and a default is the private sector writing down more than is currently suggested.
50% or so.
50%, 60%. But it's not just the private sector. This is the problem. When Greece defaults, and it will, it's going to have to default on its debt, not the debt that is held by the private sector, because the ECB and the Eurozone governments and the IMF all hold debt as well, and they hold quite a lot. A 50% default on the private sector is not enough. You've got to have the public sector also experiencing a haircut on their debt, or 100% haircut on the private sector, which is frankly not an attractive prospect.
So we look at European leaders and think, gosh, you're taking your time over this, aren't you? And then Merkel says, well, actually, we're buying countries time to get their fiscal houses in order. And it's almost as though she's sort of happy to drag this thing out. Is that a decent tactic in itself?
I don't think it is, and I think it goes to one of the central problems in the Eurozone. Markets and politicians don't speak to each other in the Eurozone in the way that they do, I think, in other countries. That there isn't a tradition of market-based finance in a lot of Eurozone countries. There hasn't been a traditional dialogue. And so markets think, well, we've got plenty of time, and the markets are saying, no, actually, you don't have it, and the longer you drag this out, the worse it's going to get. If we'd resolved the Greek crisis 3 years ago, this whole situation would be a lot easier. We've got a real conflict here as well. We've got the problems that the markets are concerned about in the near term with Greece and so on. Merkel saying, well, we just need time for Greece to sort itself out. That's not the solution. The solution is that Eurozone has got to sort itself out. If it's going to act
no longer just about Greece.
It's not. And the Eurozone is a single economy. It needs a single bank regulator. It needs a single lender of last resort. And frankly, it also needs some kind of single fiscal policy. I'm not saying a United States of Euro. I don't believe that's necessary. But we need a confederation within Europe.
Okay, so let's say we get the Greek default. When does that happen? And what needs to be in place before they can allow that to happen so that we don't get contagion? This is the goal.
Well, let's start with what needs to be in place first. We need to find some way of making sure that the Greek banks don't close their doors on a Greek default. Because Greek banks own Greek bonds. If Greece does a severe default on its debt, then the Greek banking system shuts its doors. You then get people asking questions about, well, do I want money in an Irish bank or do I want money in a French bank? And that's the real risk. The banking system is your contagion risk. If we have a Eurozone lender of last resort, someone that will bail out the banks, that breaks that contagion.
And who do you think that should be?
Well, in practical terms, I think the EFSF is there as a funding vehicle, but it probably can't act quickly enough. So some kind of combination of EFSF, ECB, I think is probably...
This is Tim Geithner's suggestion.
It is, or it's a variant of that. I mean, there are many variations on the central theme, but the ECB has got the speed to act, but doesn't necessarily want to start owning banks in Greece. The EFSF has got the collective responsibility, but doesn't have the speed. Some combination of that too, I think, would work.
Okay.
If we can get those two to come together.
We're going to talk more about this after the break. Paul Donovan, stick around. Let's get back to the crisis that's gripping Europe and driving so much market volatility. We've still got Paul Donovan, Deputy Head of Global Economics and Managing Director at UBS Investment Bank. So, Paul, before the break, we were talking about the options available for bailing out the banking system, because you believe that the full-blown banking crisis is the worst-case scenario.
Yeah.
Now, when you say it's the worst-case scenario, how likely is it that we get there?
Well, I think European political leaders realise that having an implosion of the Eurozone banking system, and it would be the Eurozone, I mean, we're not just talking about Greece here, is hardly going to be helpful. I think there is a genuine realisation that they need to do something to stabilise the financial system, and then you can allow Greece to default. So your necessary condition is you've got to have some mechanism to stabilise the system. The ECB has been arguing for years that there needs to be a single financial authority within the Eurozone that can act as a lender of last resort, that can regulate the banking system. Every other monetary union has this. You know, we've got one monetary policy, we've got one interest rate, one exchange rate. Why on earth do we have 17 bank regulators, 17 lenders of last resort? It is utterly absurd.
So when Angela Merkel's deputy Schäuble says this endangers the European Eurozone credit rating, and if you do that, then the whole thing is futile. He's talking about this monetization of Europe's debt. The Germans are highly allergic to that, but it looks like the only solution, you're saying.
Well, it doesn't have to be monetization of all government debt. You don't have to create moral hazard. But yes, you do have to have some kind of backstop. I mean, this is how monetary policy works. Even the Bundesbank, acknowledges that this is how monetary policy works. I think Schäuble is particularly concerned about, well, the AAA rating may go down if we have to make more commitments to the EFSF or whatever. Yes, but Germany's AAA rating is going to go down if Europe collapses in ruins around it. I mean, the idea of preserving what a credit rating agency considers to be AAA is nonsense. It's not as if the credit rating agencies are particularly credible either.
Finally, Paul, we spoke to Chris Flowers of JC Flowers yesterday, and he just said, you just don't know what's going to happen. As an investor, you have absolutely no idea what's going to happen.
Yeah.
And it makes it almost impossible to make investment decisions. I mean, you've been traveling around in Europe and Asia over the past few weeks. What have people been saying to you?
Well, I mean, this is Europe is the first question that comes up whenever you have a meeting with clients at the moment. They are all very, very uncertain. The real problem with this is it's politics. It's not economics. Markets haven't been used to dealing with politics for 20 years. I mean, it's not been an issue. The politics is random. There are 17 different actors on the stage in the Eurozone, plus the European Commission, plus the ECB. Nobody knows what's going on. It's very, very difficult to try and get a sense of where things are going. And a lot of investors outside of Europe are saying, you know what, we just don't have the energy to try and work out.
To try and follow it.
Exactly. Is this junior politician from Baden-Württemberg really worth listening to, or do we just ignore them? So they're saying, you know what, we just won't bother with the euro. And that, I think, is going to become an increasing trait amongst international investors. Why would you bother when the risks are so high and the effort required to understand what's going on is so great?
Yeah. Okay. Paul Donovan there, Deputy Head of Global Economics at UBS Investment Bank. Thanks very much for being with us.